To buy or not to buy? Well, that's the dilemma one faces when it comes to investing in new age tech stocks. Now, there was a time when everyone was queuing up for a pie of Zomato, Nykaa, and the likes when they stormed the Lal Street with their IPOs. But the euphoria faded soon after, as jitters over lofty valuations and paths to profitability set in, and stocks got hammered out of shape, with most of them witnessing a drawdown of anywhere between 30 to 70%. Now, most of them are in fact still trading below the IPO price. But appetite for these stocks seem to be coming back after 6 quarters of nightmare. Why is that so? Let's find out in this video. But first, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. Now, we know that there has been a lot of bad news since these tech companies got listed. But the good news is we are likely past the worst phase. These stocks have endured aggressive selling by pre-IPO investors once their lock-in periods were over. They saw attrition in senior management personnel, and most of all, a changing climate for startups across the world because of rising interest rates, which made a case for lower valuations. Now, the tide seems to be turning in favor of new age tech stocks. Domestic mutual fund managers seem to be nibbling into some of these stocks. Now, in April, for example, mutual funds lapped up shares of Zomato and Nykaa. Let's take a look at the list of new age firms that featured high on the mutual fund buy list in April. As per Prime database, mutual fund houses net bought 676 crore worth of shares of Nykaa from the market and 385 crore worth of shares of Zomato in the month gone by. Now, in fact, both Zomato and Nykaa feature in the top 10 list, rubbing shoulders with the likes of large caps like Infosys, HUL, Bajaj Finance and Reliance Industries. While they even bought shares of Paytm, the quantum, however, wasn't as large as Zomato and Nykaa. The new buy for 197 Communications was 3 crore rupees, while for Delhivery it stood at 189 crore rupees or thereabouts. So as of April, mutual fund houses held 7.14% of the total share capital of Nykaa, 7.28% of Zomato, 13.36% of Delhivery and 2.71% of Paytm. Nippon India MF, Motilal Oswal Mutual Fund, Kotak MF and SBI MF were some of the fund houses that bought new age tech stocks in April. Now, the buying spree actually started back in November. That was the time when pre-IPO investors' lock-in period expired and the likes of SoftBank, TPG Growth and Tiger Global began pairing their stakes in these companies. Now, these pre-IPO investors were sitting on handsome gains despite the 50-60% wealth erosion in the new age stocks since listing, as they had acquired shares at negligible value. So why this change of heart among fund managers? First, companies have understood that they have to show profitability to please public market investors. For a lot of fund managers, that path to profitability is an important criteria to buy into a stock. While Nykaa was profitable pre-listing, Paytm reported its first ever adjusted EBITDA profitability in the quarter ended December 2022, and Zomato ex Blinkit turned adjusted EBITDA positive in the month of January. Thanks to visibility on profits, several brokerages are screaming buy on some of these new age tech stocks and expect upside of anywhere between 30 to 90%. But remember, these stocks are still not owned by too many fund managers. Only some of them have started accumulating these stocks. Others are still somewhat skeptical about their ability to give very high returns in reasonable time frame. Why is that so? Well, the prime worry is competition. With competition rising, it is difficult to make a valuation case for these stocks even at lower prices, according to some fund managers. Let's not forget that Zomato's turf is being invaded by government-backed ONDC. Nykaa too is facing increased competition from deep-pocketed Reliance Retail's Tyra. Though as incumbents, both Zomato and Nykaa enjoy benefits of early market penetration, India is a price-conscious mass market and customer loyalty is rare. Therefore, for conservative investors, it is still a good idea to just wait and watch. The stocks are unlikely to see runaway price anytime soon. Well, for more such videos, keep following Moneycontrol.